Hello, everyone. It is nice to see you all here. I want to welcome you to this webinar that Deborah Vogt and I have put together to talk about what can we use our financial data for, our business's financial data. What more can we use it for other than talking with our accountants, talking with our bookkeepers? There's a lot more that we can. And so we are going to introduce ourselves real quickly. I'm Dr. Julie Alig of JLA Analytics.
Great. I'm Debbie Vogt of Harmony Bookkeeping Company in Wayland.
Yeah. And it's so nice to see you all here today. If you have questions throughout, go ahead and drop them in the chat. And Debbie and I both will be monitoring that throughout. And like we said in our emails, we will send out a replay later this week. So if you have to jump off, anything like that, go right ahead. Don't feel like you're going to miss anything out. And with that, Debbie, I'll turn it over to you.
Perfect. Thanks so much. I had the great pleasure of meeting Julie at a networking event back in the fall. And I think it took all of maybe 5 seconds for us to realize the complementary services that we have and just professionally how much we really enjoyed talking to one another. And that started our conversation of what if we did some sort of event together where we talk about the foundation, right? We talk about the foundation of a building or the foundation of accounting and how what we do here at Harmony really plays into what JLA Analytics provides in the way of that detailed information. So that was how we started first talking about this presentation, and over the next several months, we got together on a regular basis and came up with something that we're really looking forward to sharing with you. So there's 4 main points that we're going to make today. I'm going to cover the first 2, talking about an accounting foundation, and then we'll have an example of a curb appeal. Look at one business compared to another and what story do the books of each company tell in a way that helps the business owner understand what they have in their own business, but also maybe someone who's looking to invest or provide some financing. And then, of course, as people talk about exiting their business, what someone else is going to be looking at, maybe that business broker or that potential buyer. And Julie's going to talk about pinpointing what's driving your business. So you'll see as we talk about the accounting and that foundation, how that leads to the information that Julie utilizes. And then also starting to understand, are you in the best situation to start thinking about a transition, those next steps for you? So here we are. And so we'll jump in and talk about the accounting foundation. And I think about this. I absolutely one of those people who loves a chart of accounts more than the average bear, maybe. But talking about how important that accounting foundation is so that you can hear what your data is telling you, so you can utilize that information. I think of the accounting as that building foundation. And Julie's piece is those treasures in the attic. So you've got that information. Now what can you do with it when you've got a good place for all of this? So we'll touch on first bulking up, using some muscle today, Monday morning muscle, a chart of accounts, what makes a good chart of accounts, how to talk about the income streams within that chart of accounts so that it tells you something. The cost of earning money, so the COGS, how much does it cost you to get to that top line revenue? Expenses, everything below all those operating expenses that we all have as business owners. Talked about the curb appeal, and then building your team so that who you're utilizing to help you with which functions. So we'll first start with the chart of accounts. So something to get your numbers singing, because numbers talk, numbers tell you something. So looking at an example, now this is a very admittedly brief chart of accounts, and it really focuses on the P&L accounts, but it's also always good to visit what makes a chart of accounts something that's really solid, giving that foundation. One is it's clear. We look at these accounts, we know what goes in each of them. It's simple. And chart of accounts is a little bit, I would say, of an art and a science, because you want to balance between detail and simplicity. So you want to get some good information out, but you don't want to get too granular on any one account. You want it to be scalable as your business grows, as you open another location or have a new product line, a new service offering. You want to be able to capture that in a way that keeps that structure really solid. It's comprehensive. So you've got some place to put everything, and you'll see we are not fans of accounts that start with the word miscellaneous or the abbreviation. But you want to always have an account for everything, whether it's income or COGS or expense. So you have a complete chart of accounts, and then make sure it's got that detail in there that you're looking for. When you've got all those elements in there, you've got something that really talks about what's going on. And just to break down and look at it section by section, some of the consistency here visually, it's nice. Everything has an account number. The numbers are consistent. We're not seeing things here that way. I'd say we're bad chart of account habits under income, like an income account that's called income, which we see. So really breaking it down into something that's meaningful to you. Capturing those cost of goods, which is going to be really important for you to have, so you know what your profit margins are, so you know what your operating income, what money do you have to cover the expenses. Looking at those expenses, just a general breakdown to see, make sure you've got a place for everything. And then when we look at that interest income expense, all the others, those things live at the bottom of the P&L. We don't like to see, even though it's some of it's income, we don't want to see it at the top. Some of those other things might be your credit card points, interest that you get from a bank account, things like that. And then to show the flip side, so having fun for a minute, what do we not want to have? We don't want to have any accounts that are like red lights. So if you're ever audited, it says IRS, look in here. So I did a little bit of a comparison of what we don't want. We don't want chaos in the books. We don't want a chaotic chart of accounts. We don't want the word miscellaneous showing anywhere, whether it's income or expense. It's a catch-all. It's never good. It means there's an account missing. Something else needs to be there to help put this information in the right spot. Having something vague, you do not want a vague chart of accounts. That's not going to help you out with what you need to know. And you want to make sure you don't have any chart of accounts that are duplicates of something else, maybe similarly worded, because then you've got accounts or expenses that are income that are in more than one spot, and that's not going to help you. So as in school, neatness counts, so does spelling and grammar. So here's our example of what not to do. We've got uppercase, lowercase, numbers that are there. Sales tax, which is not a revenue account. We see some things there, miscellaneous income. So these are the things we don't want to see. We want something that's quite a bit more polished. And what we see under cost of goods sold need to be the cost of goods sold. For instance, advertising is not a cost of goods sold. So it's really capturing those things, those expenses that go into the making of your product and service, and only those things that go into the making of your product service, not anything that's more general. Operating expenses, again, we've got here, we're seeing some inconsistency with some things have numbers and some things don't. We have entertainment, which we know entertainment's not a deductible expense anymore. So if we do have entertainment, sometimes we'll actually label entertainment non-deductible. So we make sure that everything's nice and clean when it goes off to the CPA. So he or she really know what they're looking at there. And then lastly, anything that's under other, we want to catch things like an auto loan, which actually is liability, not an income or expense. So it's looking at the chart of accounts as that real tool to understand what's happening and to tell that part of the story of your business. And just a little visual comparison, right? We've got our nice firm foundation on the left-hand side. That's what we're looking in the way of a chart of accounts, something really strong that's going to last over time versus what we have on the right. Things to be mindful when you look at your chart of accounts. Look at it once in a while. Does it still fit? Look for cracks. What's not looking right? What things might be slipping through and not being properly identified. Make it like a home. Make improvements over time. Take a look. What can I do differently, better? Something that would complete this picture and tell the story a little bit better. I will say DIY, do it yourself, not always the best policy when it comes to chart of accounts. So collaborate with those folks in your world, whether it's bookkeepers, CPA, somebody you've got CFO, someone who's helping you with that, is meet with them. We don't ever encourage jumping in and changing a chart of accounts. When we do that here with our clients, we'll put everything into a spreadsheet first. We'll make sure it makes sense. And then we'll go ahead and implement it. We don't want to change names to something else because we realize we'd like it to have more detail because that name also has history in it. So if you change an account that says income and you change it to service income, it's going to change that for the years of history that you have in your software. So you want to be really mindful of that. But again, just really taking those steps to make sure you've got a solid accounting foundation so you can do those things that you want to do in the next step. So next thing to touch on is documenting revenue generation. So just looking at the top of that P&L, what's important for you to know about your income. So some of the suggestions I have here. So meaningful ways to put your income, and these are in no particular order, not necessarily grouped together, instead of just revenue, service revenue. You may have some other type of product revenue that you want to mention as well. Consulting income, fixed fee, hourly services. So you'll see the breakdown of what you can do with different ways to report your income. You might also want to do it by product line. So see specifically how are each product line working for you so that, again, you can utilize that data to better understand what's happening. Or sales channels. You might have some sort of brick and mortar business where you're selling some stuff online, wholesale, retail. Again, capturing that so that when you look at your chart of accounts and you look at your reporting and you work with someone like Julie, you're getting a really nice picture of what you've got there. Some of the things we don't encourage, accounts that are called income or how the income's coming in, such as Stripe or credit card or, again, miscellaneous. These are all things we see, which is why I bring it up. But there are better descriptors out there for everybody than using anything that's vague or not helpful. Moving down to the next on the P&L, we've got the cost of earning money. So taking the time to do these small details can yield big rewards at information. So think about your cost of goods sold, what's made up, what are the costs in the direct delivery or putting together of your products and services. Separating this out will give you a more clear understanding of your profit margin. It will help with budgeting and forecasting. If you ever choose to compare one business to another, you can see how you're doing on profit margin within your businesses. Even industry standards, it might be a way for you to see, are your costs competitive? Have they changed over the years? Do you need to work with that vendor to either maybe renegotiate or perhaps find out if you can buy in greater bulk to get better pricing? When you have that broken out that way, you have those tools and you have that data that allows you to go ahead and do that. Will also help you learn how your costs will behave if you were to scale. So again, if you say, if I want to scale and do this, what does this do to my COGS? So again, that data that's going to help you jump in there and really understand what's happening with the COGS. When I think about money as a business owner, and also as we look at people's books, really thinking it's not just about the money you make. It's not, that top line's wonderful, that top line's beautiful, but the bottom line's really important too. And it's about how much you keep, as our Rich Dad, Poor Dad friend will tell you, and how you have that broken out to give you the information you're looking for, because holding on to that cash can make for a better bottom line for owner's equity. So increasing your own equity in your business, give you a nice, healthy cash balance because cash buys options. Like I just said, it helps you maybe buy in bulk, buy in advance, different things. So if you build that cash balance, you've got some options you can do there, including reinvesting some of that money into your staff and into your service or new equipment. Maybe it's time to replace some of the laptops for your team or other equipment that you have. Holding on to that cash and knowing where it goes is going to be a big advantage to any business owner. So I just did a little chart here and talk about drilling into the detail and what's available. And this is if we're using QuickBooks software, I would imagine a lot of the other software products have similar features. But if you want to really drill in and see where that money's going, again, giving you the opportunity to do better budgeting, better forecasting, better negotiation with your vendors, or just understanding of where the money's going, taking the COGS, taking the operational expenses, and putting it into some broken out details, such as classes. So maybe you have departments or different revenue streams. Maybe there's client segments. You want to track your B2B expenses versus your B2C expenses. So those classes, which are built into the software, allow you to break that out in a way that gives you that next level of information without overwhelming your chart of accounts by adding more accounts to break it out, utilizing things like classes and project tracking. So project tracking is great for businesses that really want to see what's the cost of that particular project. It could be a consulting project, but it could also be some sort of building development or trades. We work with a lot of large landscapers and they want to, track those projects. So having the opportunity to do that and utilizing project tracking will give insight into those numbers. Location tracking, real clear, anybody who has multiple locations under one entity, again, will allow you to run the reports and see how each location is performing. And then lastly, QuickBooks has a tag feature, which is really handy for kind of smaller opportunities. So it gives you a little bit more flexibility. You can put a label on it. Maybe you want to see how much, an annual meeting cost. Maybe you want to see how much a particular trade show cost. It allows you to create a tag, and then you can just tag each of those expenses, and you can run a report. So again, not overloading the chart of accounts, because for any one event, you may not want to have broken out chart of accounts, but that detail is going to be important to you nonetheless. So there's a lot of flexibility in how you do that. I think being in January, even though we're at the end of January, it's such a good time to revisit this because things can be put in place for this month. Then you get the full year picture with the benefit of a more detailed, either the classes and tags or chart of accounts. And then year after year, you're going to be able to do some nice comparisons. So it's a good time of year to get it done, but really any time is. The last thing that I'd like to hit on is just talking about EBITDA. So I think most of us probably know what it is, but it's a measurement of the operational performance separate from the interest, the taxes, the depreciation, and amortization, which, from business to business could really vary, even within an industry. So making sure what your EBITDA is, so you know how well your company is doing with the business, how much cash you're generating, and really what you're managing for future growth. So wanting to take a look at that because it will let you know what your profitability is separate from all those other influences of interest, tax, depreciation, amortization, just that operating piece of it. And this is where I have my side-by-side comparison. So we've got Alpha Company. I use some small numbers here just to keep it really simple, but in real life, you might want to add in your mind a couple of zeros onto the end of that to feel like it's maybe more reflective. But here's a company, $1,000 in sales, $800 in operating income, and after all the expenses, net income's $150. So really clear. But I compared it now to Beta Company. Same sales, same COGS, so operating income's the same. Very different bottom line because they are heavy on interest, taxes, depreciation, amortization. Reason why these could be different, Alpha Company could be a company that really started, was bootstrapped by the owner years ago, and they've paid off everything. They don't have any debt. They're in really nice shape. They're keeping a lot of that wonderful top line profit, where maybe Beta bought into the industry. They're more capitalized. They have loans that they have to pay off. Different things like that will cause that bottom piece to be much heavier. So if we look at Alpha Company and we look, they've got an EBITDA of 300. Pretty clear, what they're doing there. What's the EBITDA for Beta Company? Believe it or not, it's also 300. So it's the same. Their income's the same, their COGS are the same, the general expenses are the same. So when you're comparing one to the other, you're really comparing the operational profitability and you're removing all the factors that can be wild cards. That could be very specific to a particular owner and the way he or she runs that business. So this allows someone to assess the cash flow, the business performance of this company, and also be able to compare business to business. And I think that's a lot of the times when we hear about EBITDA, it's related to a sale. And someone really wants to compare, how's this company compared to another one? And that's going to strip away those other factors and really give an idea of what that operational performance is. So two different companies, some of it income, COGS are similar, but very different when you look at it from the expense side, but even when you look at from the EBITDA side. And then the last thing before I turn this over to my friend Julie is don't go it alone. There are people there to help you. The data you have in your systems right now is wonderful. It's great. And if you were to work with Julie, she would be able to tell you all kinds of things about it. You don't have to do a big overhaul, but I think it's important to be mindful and to go back and to take a look. And is this really telling me what I need to know, not just now, for 5 or 10 years? So if you've got a bookkeeping team, whether it's in-house, out-house, external, your CPA, whomever, data analyst, you'll get to meet Julie and hear all about what she does. She's on your team as well as your CPA, tax preparer. Perhaps you have a CFO, COO, those kind of folks. So utilize your team to help you get to where you want to go so you can take advantage of some of the reporting that's available and really get that deeper understanding of how your business is doing. And I will end there, Julie. I don't know if there are any questions for me in the chat or if we're ready to have you jump in and share.
I am not seeing any questions, Debbie.
Okay. No, that's great. Thanks so much, Julie. I'll stop sharing and you'll hop on.
Okay.
All right.
That sounds good. And while we're flipping over, I was taking a couple of notes while you were talking, and I loved how you said cash buys options. I'm sure you've said that before, but for some reason, it struck today a little bit differently. And I just really liked being able to hear that.
Yeah, that's true. Sometimes it's hard to hold on to that cash, but you think about what you can do with it and the importance it has, even if you don't do anything with it and you just have a nice, healthy cash balance. It's a nice thing to show when you're looking at a sale or just keep really wanting to understand how your business has been performing and feeling good about all that you've put in.
Yeah, no, that's good. That's good. Thanks for that. Can I get a thumbs up from you if you're able to see my question mark screen? Yeah? Okay, good.
I can see that.
Okay, thanks. So from here, some of you might be scratching your head saying, okay, so far, Debbie has been talking about financial things and talking about chart of accounts and expenses and things. And then she came up with this team and she included a data analyst on the team. What the heck is up with that? Why would she include a data analyst of all things on the team? So, spoiler alert. So, let's go back to what Debbie put out several slides ago, that old chart of accounts, right? And this one is the clean one. So we've got revenue, we've got COGS, we've got expenses. So now this is perfect for the kind of analysis that a data analyst would be able to get in there and start helping with and uncovering what's going on in your business. Why? Because this is what it looks like in the background. I don't know how many of you have thought about it this way, but this is pure gold, at least to someone like me. I know to some people, they don't want to see tons of spreadsheets with just columns and columns of numbers. But here, look at what we've got. We've got an order date, for example, for all of these. And oh, by the way, all of the data and all you're saying here in mine, just as well as with Deborah's, it's not any client data. This is all fake data from different sandbox applications. So this fake data here has a client that is selling, and we've got order date, we've got profit already calculated in the back end, right? And we've got sales, we've got revenue calculated. And so that's gold. That's gold to me, because what we can do is we can do an analysis, something like this. So just being able to know the different kinds of the revenue, the sales over a period of time, we can chart out, I can chart out something like this, where you see that solid line there is the revenue pattern for a fake business. And notice how it stops and then it picks up again, but the line is a lighter color. Those are projections. And with that, I'm able to do projections. I'm also able to do what's the best case scenario and what's the worst case scenario for something like your revenue. And again, I'm just using the same numbers that Debbie did, except I'm looking at them using different tools. It also lets me do something like this. So this is for a hypothetical big box store that sells all kinds of office supplies. And you can see here, this, you might not be familiar with this kind of a visual here. It's called a tree map. And you read it from up here in the top left down to the right, just like you would read on a page of paper. And here, the size of those rectangles in there is proportional to how much of the profit for the company that each of these categories made up. So here we can see technology made up the largest. So think here, different kinds of software. Office supplies made up the second. So pens, paper, folders, and furniture made up the least amount. Still made up a good amount, but it was the least of the three. Now, that kind of analysis, it might, if you were a business owner, that might surprise you. That might surprise you and your sales team or your marketing team. You might have some very different ideas about what's actually driving the value, driving the profit in your business. So these kinds of analyses can start to uncover those. And again, same numbers as the ones that Debbie used before. Being able to look at your product categories because you've got clean charts of accounts, clean classes in your QuickBooks, or you might be running NetSuite or something like that. Also, let someone like me do projections, not for the whole business, but I can do projections for each of those product categories. So just like we saw those projections earlier of sales for overall, we can see the projections here for technology, office supplies, and furniture. And here, again, the solid line indicates the actual historical numbers. And then the shaded and the lighter colored line, what's the most likely? and the best case and the worst case scenario. And knowing this kind of information for your business is going to be really important when you're thinking, are we going to be able to hit the goals that we've set for ourselves in 2025, in Q1? Because if you set a goal that's outside of, for example, that shaded region, the numbers are saying it's very unlikely you'll be able to do that. And if you've made more decisions based on that, then you might have some difficulties actually meeting those goals in the coming months, in the coming quarters. So I wonder, I'm not sure how many of you might be familiar with something called the Pareto principle. And so the Pareto principle is basically 80%, 20%. It's the 80-20 rule. You might know it by that instead. So 80% of your results are driven by 20% of your actions. Or in this case, when we apply this to our business, as some researchers at MIT have done, 20% of your products that you're selling account for 80% of your revenue. They did that a little more, what we'd expect from MIT. They were a little more precise than just 80-20. And this is the kind of analysis that I will do sometimes for clients who really need to start looking at, okay, what really is making me money? Is it the products and services that are in bucket A that are actually profitable, which tend to make up about 20 to 30% of a business? Are they the ones in bucket B that are only marginally profitable? And again, these tend to be another 20 to 30%, but keep in mind, marginally profitable. Or are they in bucket C, where they're actually losing money? And typically at least 30 to 40% of a business's products or services are going to fall into bucket C. So with this kind of analysis, what I do, sneak peek for you all here, is I go behind the scenes, and let's say this is a hypothetical client who sells organic skincare items, and they want to know their soaps, their lotions, and their balms and serums. So they've got 3 classes. They've put all of their products into those categories, and they ask me first, where's all of my revenue coming from? So this is the breakdown. And notice down here, balms and serums, 52% of the revenue is being driven by those. So if we stopped there, then we would be thinking, okay, that's the lever that we need to pull in order to be making some real progress for improving our cash flow, improving our bottom line. The kind of analysis I did, though, actually found that the soaps were the ones that were the most profitable, and the lotions were in that middle bucket B. And then actually those serums and shampoos and all, they weren't profitable. The business was actually hemorrhaging money because they weren't drilling down enough to see that those, even though they generated a lot of sales, the cost of goods sold, whatever else gets factored into that, they were really causing those to be in the red. And so moving forward, I'm able to provide the business owner with the confidence to say, okay, I know that if I'm going to increase cash flow, do something like that, I'm going to focus on the soaps. I'm going to look at that middle bucket, B. I'm going to look at a little more detail there because some of them are profitable, some of them aren't. So let's see what's going on with those. And then really revise marketing and sales around the strategies for that last bucket C. So when we're thinking about this, I like to remind clients some of my colleagues that having your financials in good order, right? Not having that IRS, look here, that flag or anything, not having those in your books is just, it's just good business practice, right? And I'm not here to tell you that it's not. That's extremely worthwhile. But I also want to shift our focus just slightly and point out that for those business owners who are starting to think about what comes next with my business, what comes next? I might be exiting out of this business. And that can look in a couple of different ways, but having your financials in order really is table stakes if you want to be doing anything going forward with your business. And so having your financials in order, table stakes, but then focusing on your cash flow. People who are interested in acquiring, in merging other businesses are going to be looking at whether or not yours has a positive cash flow. And they're going to be really looking at whether or not that positive cash flow is likely to continue for the next 2 years. 2 years tends to be, again, pretty typical when we're talking about business exits. And so if for no other reason that, again, cash gives you options, right? Being able to figure out what is bringing in the cash, the profit, how can you boost that is going to not only help you grow that healthy, sustainable, viable business, it's also going to give you those options when, for whatever reason, it comes time to think about exiting. And in the exit planning community, there are several studies have shown that around 50%, some up to maybe 55% of all exits or business transitions are unplanned. Think about death, think about divorce, think about some sort of financial distress that the owners get into. Think about disability. Over 50% are not planned. And so again, cash gives you options. If you're talking about how do I go about exiting? What does this look like? I just sell it to someone, right? There's a lot of options out there for you. And this is certainly not a webinar getting into the details of that. But I will point out there's some internal and some external options to put on your radar. You might want to, if it's family owned, you might want to transfer it within your family. That might look like succession. That might look like something different. But keeping it within the family, that might be the best choice for you. You might implement an ESOP, an employee stock option package. You might sell it to other existing partners. You might have management buy you out. So there are others, and there are certainly more flavors of these kind of internal ones, but just to start getting your wheels turning, you could do it that way. There are also external options, okay? Third party could come in looking for a strategic acquisition. They already own something, and adding yours on is going to bolster theirs, right? Private equity. Those are the types of things that sometimes you'll just get a call one day and say, hey, we want to buy your company. Where did this come from? Are you even thinking about this? Could be an external, could be an orderly liquidation. Again, distress, something going on in the economy. Could be recapitalization. Again, these are things that just know that they're out there. There are lots of different financing options. For those of you who haven't thought of this, it's not simply I'm going to exit, I'm going to sell it, and then I sail off into the sunset. There's a lot of different options for you out there. But again, cash is going to give you options. Cash is king here. So I want to leave us time for questions if anyone has any questions. So with this, I wanted to leave you with a couple of takeaways. One, again, having solid financials as your business foundation. So working with someone like Debbie and her team at Harmony, or with yours or other accountants or bookkeepers, really making sure that you've got your cost of goods sold in there, because it's not going to be possible to calculate with any kind of precision a profit if you don't know what the cost was. And really understanding that chart of accounts, because having those things broken down into those categories, think back to that spreadsheet that just was literal a gold mine for someone like me on your team. If they're in those categories, then I can just go to town and go to work. Keep in mind that top line revenue certainly is important, without a doubt. However, the author, and I'm blanking on his name now, but Rich Dad, Poor Dad, it's not so much how much money you make, it's how much you take home. So don't forget to pay attention to how much profit you're actually generating, not just your revenue. That 80-20 rule to pinpoint your most valuable products or services. And even just doing that top level analysis of the 20-20-60, something like that breakdown, can be really informative. When you're starting to think, okay, I need to pull a lever, which one do I pull? Which one is going to get me to where I need to be? And then, of course, doing a little more detailed analysis is something that you can bring me on, or someone like me on, to really be able to parse that out more. And then think about what's your curb appeal for whatever comes next. Once you've gone through and you've got a solid financial foundation, you've got your chart of accounts, you understand what is actually driving the profit in your business, are you going to keep it? Are you going to just fix it, optimize it, or are you going to flip it? Are you going to look for someone to buy or to invest somehow in your business? A lot of people aren't quite thinking that, but there's a lot of, as people in the business will say, there's a lot of froth out there. There's a lot of interest in buying businesses right now. So you want to make sure that you do it on the best terms for you, not for whoever's buying. And I'll leave you with this fun fact. All of the analyses I did were using the same data that Debbie uses. I'm simply using different tools. You don't have to go digging for more data here, there. Think, oh, having a data analyst on the team, we don't have any big data. So I certainly couldn't use her. Data analyst is really key on your team. And with that, I will end and turn it back to Debbie. Do we have any questions?
We don't at this moment, so I'll give people a chance to think of things. One of the things that you mentioned, though, that I'll call out, a number of things that you said that I really liked hearing, but the one that stands out for me at the moment is when you look at what product or service is, bringing in the most revenue, it doesn't mean it's the one that's making you the most money.
Yeah.
For example, looking at it and saying, people love it. They love the service or they love this product. It's not, bringing me the profit that I need. And to know that and to be able to say, wait a second. And then, like you said, pulling the levers, you work more with the ones that are, or tweak this one that people like. How can you make it profitable? Understanding those components of what's causing it or what the costs are really allow you to look at it in a different way and make it more valuable to you. Clearly, it's a product people want, but it just also needs to make sense for the business to be providing that.
Yeah, that's a really good point. A lot of times, and running a business is not for the faint of heart. As people on the call know,
Yeah.
there's a lot to keep track of, much less start looking more strategically at analyzing your books using these tools, right? But if you start thinking, yeah, this product is really popular, I'll just go gangbusters on this product. I think that's, from what I've seen and what I've heard, that's where a lot of businesses start going down a, a difficult path. And yeah, being able to map that out and map out these products are the ones that are really popular. Who are the customers that are buying them? Because you've got different types of customers. So which ones are buying the profitable ones? Which ones are buying the unfortunately not profitable ones? And how can we strategize around that?
Yeah, that's amazing. The information you can get out of those numbers and that data. So that's terrific. And
So Annie's what you use. Yeah. Yeah.
I don't see that we have any questions. So I can thank our participants for coming.
Okay.
Thanks so much for your time. I hope you took away some great lessons, some things you learned. Reach out certainly with any questions.
Yep.
And we appreciate you spending some of your Monday afternoon with us.
Yeah. Thank you so much. And we will be sending out the details to get a replay within a couple of days. And as always, if you've got any follow-up questions, feel free to email or reach out in other ways to me or Debbie or both of us. You've got two people here who just love chatting numbers.
Yeah.
All right.